Hello, you're welcome to chapter 4 overview. In this chapter, we're going to look at banking, and this is our first chapter in this course. Now, as most of you know, the chapter looks at different elements within the banking concept. But I just want to focus on item 2, which is the bank statement and reconciliation process. And as you know from your own reading, that the bank reconciliation is one of the control companies use to have or to maintain a control of cash. So, what do we mean by bank reconciliation? Again, ideally, what we are doing when it comes to the bank reconciliation process is try to match the balance of cash in the bank account with the balance of cash in the company's own records. Now, so what I mean by this is some of you have taken accounting 120, right? Some of you will be taking this sometime soon. So what do I mean is as a company, what we try to do is you'll keep a cash account to try to you track all the payments in and payments out of the cash account. At the same time, we also have a bank account. That's where we keep our money at the bank. But mostly this account, it is done for us, and the bank will do this. And the easy one is when the bank sends you uh, a bank statement. So when the bank sends you a bank statement, it basically gives us an idea or an overview of what transpired in that account as far as what came in and what went out. And then, of course, the balance in that particular account. The same thing for cash. We track our payments and payments in our cash account as an organization, and then at the end of the month or at the end of the year, again we try to determine what the balance should be in that account. And again, this is what organizations do. But for the sake of this chapter, I think we are not using the word cash account. We are basically using the cash book, right? So this is basically the register, the book you're given when you sign up. And as an individual, for example, you want to make sure again you are tracking the cash and how you're spending it and how much is coming in, and therefore you're using that book to try to track cash. Again, this is a control measure, and of course the goal is always at the end of the month the balance you have in your cash book should be or should reflect somehow, it should be the same as the what you have in the bank as reflected through the bank statement. But the truth of this is always at the end of the month, if you try to match what you've been recording and what the bank has been recording as reflected through the bank statement you receive from your bank, you'll find that these amounts are not matching. So what we're trying to do with bank reconciliation is to try to match these two totals so that we have the same number on both sides. So we're going to make some changes either on the bank side and make some changes maybe on the cash account side or the cash book side so that we should have a similar, because the amount has to match, right? But because it is not matching, there are reasons why it is not matching. And mostly, the reason why you're going to have the two balances will not be the same is because one is going to be because of the timing differences. And I'm going to explain what we mean by this. The second could be because of errors. Again, this could be either intentional or non-intentional. So it could be that or just non-intentional. But again, our focus is to make sure that we identify these differences and to identify these errors and fix the errors. If we identify the timing differences, what is causing the timing differences, then we can go ahead and try to fix to have those two accounts balancing. So again, this is basically what we are trying to do when we are looking at the bank reconciliation. So I just want to show you here uh, a chart that you can use, and this can guide you as you try to think about how you will go about in undertaking a bank reconciliation. And I want to think, I don't want you to cram nothing here. So do not cram those items you are seeing on the checkbooks, on the checkbook balance side, or cram the items you're seeing on the bank balance. I just mentioned that the reasons why there will be differences between the amounts on the checkbook side and the amounts on the bank balance side, the reason is going to be timing differences and errors. Of course, we have seen the errors are being reflected here. The errors are also being reflected here. So the errors could be either the bank made an error, or you as an organization, you made an error when you are recording those transactions. So it could be an error. Again, the error could be either could be minus or a plus or minus error, and we're going to see how this happens when that error is made. So long as we can identify the error, then we should be able to reverse or fix that particular error. The other one, the major one, is all a timing difference. And the timing difference, again, is just going to be, if you think about it, again, do not cram nothing here, right? Just ask yourself, when you are recording your transactions in your checkbook balance, so when you walk around with that checkbook balance and you go buy gas, for example, and you pay, let's say you pay a check, right? Or you go to you got an ATM machine and withdraw some money again. You want to make sure that you are tracking all those transactions and recording them accordingly. That's what you're trying to do. Uh, and you have to remember then there will be some transactions that appears on one end and do not appear on the other end. So they will appear on the bank balance side, but do not appear on the checkbook balance. There will be also other transactions that will appear on the checkbook balance side, but will not appear on the bank balance side, right? And again, the reason is because of those timing differences, right? And because of that, we need to trace those transactions. For example, let's just mention a few here. The interest earned here, this is you earn interest. So you have money in your bank, either in a savings account, and you earn interest on that amount. Now, think about what happens if you earn interest on the money at your bank. It is true then that interest has been added on your bank side because the bank is the one that is, accounting for this. You earn interest, this amount was already added to your bank side. But in your checkbook, you're not aware of that interest earned until when you receive the bank statement. So when you receive the bank statement at the end of the month and you're walking through the bank statement and you realize, oh, I earned some interest I didn't know about, right? And because you identify that element in the bank statement, what you need to do is that amount has been reflected in the bank balance. So the bank balance at the end of the month seems to show the interest being reflected, right? But in your checkbook or in your cash account, the record you're keeping to yourself, right? In that regard, the interest is not there. So what you need to do is to increase your checkbook balance by that interest earned. Again, you only knew about this because you saw this on the bank statement. There's also non-sufficient check, right? Non-sufficient check, you wrote a check to a customer. So as an organization or as a business, you wrote a check, a payment for something. And let's say you send, or a customer gave you a check. A customer gave you a check, bought something in your store, and gave you a check, and you send this check to the bank. But then, when the bank receives the check, they don't increase your amount, right, in your bank balance, because remember, the customer does not have enough funds. So it becomes a non-sufficient check, and therefore what the bank is going to do is not to increase your bank balance, but that non-sufficient check. But again, you don't know about this until you look at the bank statement and you realize, oh, there was a non-sufficient check. But I want you to stop and think. When you wrote that non-sufficient check, when you wrote the check to the bank, because you didn't know is going to turn out to be non-sufficient, right? When you send this check to the bank, on your own side, you increased your checkbook balance by the amount of that check, right? So you already accounted for this check on your on your on your on your own record in your own records, right? You did so. But by the check going to the bank, you realize at the end of the month that check wasn't good. It returned as insufficient. And because of that, what you're going to do is to remove that amount from your checkbooks to reverse your initial recording, because you recorded that check by increasing your checkbook balance. But it turned out it was non-sufficient. The bank didn't honor that check, and because of that, you have to reverse the recording. But so what you have to do is to minus that amount from your checkbook balance. Then there's also, for example, the service charges. Let's say, for example, you have a checking account and the bank charges you, $12 a month, or $30 a month, whatever it is, or any other service charges the bank will charge you for providing that account to you. Again, you don't know about this service charge until again you receive the bank statement and you run through the bank statement and you realize, oh, they charge me $12 as a service charge for whatever service they provided to you. And because they charged you a service charge for that, they had to take out that amount from your bank balance. So what you have to do is to go to your checkbook balance side and again reduce your balance there by the amount of the service charge. And of course, if there was an error, again the error has to be recorded, has to be taken off accordingly. For example, if this error was increasing your checkbook side, you made an error on your side. You wrote a checkbook, and in this, for example, you wrote a checkbook. So one of these checkbook you wrote to a customer gave you, or in your books of record, you wrote the check to be $120. But in real sense, instead of writing 120 in your checkbook balance side, you wrote, let's say you wrote 20. So you increase your amount by 20 and not increasing your balance by 120. So in this case, you missed out at $100. So what you have to do is to increase your balance by $100. That was an error on your side. You just missed the one digit one by recording 20 in your books and not recording 120. But when this check went to the bank, of course the bank recorded the check as 120 because it was a check for 120, right? So the bank did a correct recording, but in your end you only recorded $20 instead of 120. For that reason, you have to increase your your checkbook balance by $100. So again, that's how you can identify the error and fix the error. Then there's also something else that happened on the bank balance side. For example, deposits in transit. So let's say close to the end of the month, you send money to the bank. You record three bags of money. And you send to the bank, or yeah, and when you send this towards the end of the month, let's say this is on a 28 or 29 or a 30th, whatever it is, and you recorded a deposit of, let's say, 200. But by the time the bank is issuing you the bank statement, the the $200 is not being reflected in the bank statement. And the reason is because by the time the bank is issuing the bank statement, they had not accounted for this, right? But this amount is going to be accounted for, of course, in the next month by the bank. It just it won't show up on your bank statement. But remember, you are recording this on a monthly basis. So what you want to do is this deposit in transit, because you already recorded this in your checkbook balance side, but there's a delay, right? That timing difference, it means then you have to increase your bank statement balance by $200 to reflect that $200 that is delayed, or what we call the deposit in transit. Then there could also be some outstanding checks. Again, for outstanding checks, what you want to do again is just to make sure those checks are also taken out. Again, what we mean by the outstanding checks, the checks have not been recorded for payment when it was sent to the bank. So when you send the bank did not uh, uh, let's say this, so what we mean by this is that checks that you send to the bank, but again, because of that, the 30th, the 28th, whatever it is, the end of the month, the bank did not pay those payments out, those checks out. And for that reason, remember, on your checkbook side, you have already accounted for this on this side, but in your bank statement, because of the timing difference, you receive the bank statement and it does not reflect those outstanding checks. For that reason, then you have to identify those outstanding checks and deduct those amounts from your bank balance side. And of course, if there's any error made by the bank, should also be taken care of accordingly. So again, the key idea behind the bank reconciliation is just, again, you don't want to cram nothing, you don't want to memorize nothing in terms of the nature, the what are items, whatever. No, what you just want to do is to stop and think and ask yourself what you're doing. What you're doing is you're trying to reconcile the checkbook and the bank statement. And for sure, you have to know there will be some things that are going to make those two balances not equal. That could be the timing differences. That could also be errors. If you can identify the errors, fix the errors accordingly. If you can identify the timing differences, the deposit in transit, uh, the outstanding checks, those direct deposits, and so on. If you can identify those elements, then it just treat them accordingly. And by so doing, at the end of the day, what you're going to have is where the two balances are going to balance. They're going to be the same. If they're not the same, you just have to repeat and identify where you made an error. So again, I'm going to show you through this. We're going to walk through an example that's just going to demonstrate how you go about in trying to undertake the bank reconciliation. But I just want you to think about it intuitively. What are we doing here is trying to balance these two sides by identifying the reasons why these two balances do not match and fix those issues accordingly.